Hey, what's up guys? In this video, I'm going to share 5 biggest investment mistakes that I've made that has cost me hundreds of thousands if not millions in dollars in lost opportunities and hard-earned money. Now these were painful and frustrating, and honestly, they're pretty avoidable. If only someone had told me this when I was younger, so I'm going to tell you now. Now, whether if you're just starting out on your investing journey or you've been in the game for a while now, I promise that you'll learn something valuable here. So stick around to the end because I've got one bonus mistake that most people never talk about, and it could be the difference between staying average and building real wealth. So let's go. Hey guys, my name is Jean Lu and welcome to the channel where we talk about personal growth, finance, and everything related to bettering ourselves and live a more meaningful life. Now, I'll try to make it as relatable as possible because I'm just an ordinary guy on YouTube sharing my experience, hoping that some of you watching could take away something from these videos. Now, quick disclaimer, I'm not a financial advisor. I'm just a guy on YouTube sharing my personal experience, so these are not financial advice. I'm not recommending anyone to buy or invest in anything that I've mentioned in this video, so always do your own research before investing and only invest in what you can afford to lose. Now, the first mistake is not starting early. Now, looking back, one of my biggest regrets is not learning about investing when I was in my early 20s. Now, if I started just a few years earlier, understanding how to invest, even just a little bit with what little salary that I was earning back then, I honestly believe that I could reach financial freedom and be retired by now. If only I knew what I knew back then. And while we are young, we don't have much risk, responsibility, and commitment. We basically has nothing to lose, and that was the best time to be investing because we can afford to take bigger risks. And like I've said before, the biggest risk is where real wealth are made. And when we are young, we have time to recover if we messed up. Now, I can't say the same for me now because I'm reaching 40, but instead of investing back then, I was spending my hard-earned money on material things like clothes, gadgets, vacation, cars, and all, thinking that I deserve to reward myself for working hard. You know, work hard, play hard, they say. But what I didn't realize is that every dollar that I spent was an opportunity loss. I wasn't thinking like an investor. Instead, I was thinking like a consumer. Now, I'm not saying that don't spend your money at all and have fun, but if we could change our mindset from impulsive buying expensive good to what if I invested this money instead? How much return could I possibly get? Will I be able to buy this expensive gadget later for free from the profit that I could potentially gain? Now, if we could just switch our mindset from an investor, you will become more disciplined on how you spend your money. You will start to think long term and how this concept of invest now and then enjoy later will set you up for your future. Now, let me give you an example. Back in 2010, I bought my first car, a Honda Civic FD. My dream car back then. The car cost around $120, and back then I was only earning around 4,000 ringgit. My dad helped me a little bit with the down payment, but I still had to fork out 1,000 ringgit every month to repay the loan for 7 years. Now imagine just earning 4,000 and you have to pay 1,000 a month for your car loan. That was 25% of my income. That was tough. But you know, I was young and naive at the time, and that was my dream car. So I didn't really regret it. I really loved the car. It was a great car, but I could have done so much more if I bought a cheaper car and invest the remaining money that I have. Instead of spending $1,000 every month on a car, I could have gotten something half the price and invest the remaining $500 into a stock market every month and gotten 300 to 500% return on my money instead. I imagine if I put into a stock like Amazon or Meta or Google, I could have gotten a 3,000% return on investment right now. I could have bought a few Honda Civic or even a more luxury car for free. Now, of course, in hindsight, it seemed obvious, but my point is to invest as young as possible. And especially if you're a parent, educate your children on finance and get them to learn to invest as young as possible. Now, the earlier you start, the more time your money has to grow exponentially. And also, if you fail, you have more time to recover and try again. By waiting to get started, I lost out on so many years in compounding return and countless opportunity to buy great assets during market crash. It was truly one of my biggest mistakes. Now, my second mistake is buying a property first. Now, this one might trigger some people, especially if you're into real estate. But hear me out. I made the mistake of buying property too early. And worse, I bought two. I was the typical Asian guy who thought that buying a house was proof that I'm a man of stability. So I rushed into buying my first property when I was able to. I thought I was making a good investment, but in reality, I did not understand about the property game at all. I wasn't a savvy real estate investor, so I was just following what everyone else was doing and what those property sales agents was telling me. which all they care about was earning their commission. But I was to be blamed as well because I did not educate myself or did any research on what I was getting myself into. And it turned out to be one of the worst financial decisions that I've made. See, in Malaysia, property prices, specifically residential properties, over the last decade has grown less than 2% annually on average. And once you factor in inflation, loan, interest, maintenance, legal fees, stamp duties, agents fee, MOT, and all the other extra hidden costs, the return were almost non-existent, and most time even at a loss. And worse, my rental income couldn't even cover the monthly installment. But unlike stocks, real estate is not liquid. You can't just sell your property the following month instantly if you need the cash. Now, in comparison, the US stock market returned over 300% in the last 10 years, and that's an average about 13 to 14% a year, and it's liquid. You can buy and sell in seconds, and you don't need to manage repairs, deal with tenants, or pay any hefty fees. I've lost so much opportunity cost by paying all these fees and interest every month to purchase a property, which are in the hundreds of thousands. And if only I used this money to invest in the stock market or some other emerging asset, I would have gotten so much more return compared to buying a property. Now, I'm not saying don't buy any property at all. There are still some hidden gems out there, especially for those savvy property investors, but it's just not my forte. I know people who make really good returns investing in property, but know that they have either done a lot of research and extremely experienced in investing in property, or they might have already built a lot of wealth. Hence, buying a property to them is just a way of diversifying their investments. So if you have someone young and just starting out, you don't have much capital, my advice is don't rush and buy a house. Instead, rent and invest first in something like the stock market or other emerging assets. Now, in terms of investment, on average, property could give you an annual return of around 5 to 6%, while the stock market, particularly the US stock market, could give you 10 to 12% annually. While both are not guaranteed, just by looking at the statistic, the stock market seems like a better bet. There's no hefty fee, managing, repairs, interest, tenants to deal with, and the best thing, it's liquid. So my advice is to grow your portfolio, let your investment work for you, and only think about buying a home later when it truly makes sense for you financially and emotionally. Now, the third investment mistake that I've made is trading instead of investing. Now, when I finally got into investing, I took a little detour. Instead of focusing on long-term investment, I got caught up with trading, especially swing trading, which when you buy a stock at a certain price and sell it within a couple of days, weeks, or months. You see, I was hooked on learning technical analysis, reading chart pattern, candlesticks, and trying to time the market. I thought that was cool and that's the way to make real money. And to be honest, I was influenced by a lot of these gurus online showing off their Lambos, claiming that they have made thousands every day just by trading. So I started with paper trading, which is basically trading with fake money, and then I put in real money once I felt a little more confident. And at first, I did make some pretty good profits, and I thought this is it, I'm a professional trader now. But very quickly, things went south and the market always have a way to humble you down. I realized back then I had no idea what I was doing and I was inexperienced. I was reacting really emotionally and panicking when the price dropped. And once you're in panic mode, you make terrible decisions. Now, the truth is, timing the market is incredibly hard, even for the professionals. There's a famous saying that time in the market beats timing the market every time. Meaning, just buy and stay in the market for as long as you can, buy more when the market crash, hold instead of constantly trying to buy in and sell out of the market, trying to time the top or the bottoms. And here's a crazy stat for you. If you missed the 10 best days in the market over the last 10 years, your return would have been cut by half. And that is why long-term investing always wins. So instead of trying to be a trader, I should have focused on understanding great businesses, learn how to read balance sheets, and practicing dollar cost averaging. And then use technical analysis to read the charts to give me a better understanding and some edge on buying at a better price. And then keep continuing to buy over time and holding it for the long term. Hey, if you're finding value in this video so far, please do me a favor and hit the like and subscribe button to support the channel so I can continue to bring you more valuable content. And also leave a comment below if you have any question, I will answer it to the best I can. Now, the fourth mistake that I've made is buying without research. And this is a big one. See, I bought stocks, a lot of them, just because someone on YouTube said that they were undervalued or they're the next big thing. But I didn't understand the company at all, I didn't look at the financials, I didn't even know what the company business was. And the moment the price dropped, I panicked and sold at a loss because I have zero conviction and I didn't know what I owned. Some of these companies were genuinely bad businesses they never recovered. And I learned the hard way that if you don't understand what you're buying, you have no business investing in it. So now, before I invest, I ask myself a few questions. Is the business profitable? Are they growing every year? And the second question is, if it's a new business or a company, is it growing every year and moving towards profitability? And the third thing is, does it have an economic moat? Something that gives it an edge over its competitors. The stickier the business, the better. And the fourth important question, what is the market cap of the company? Is it a giant like Apple and Microsoft, which their shares are worth trillion? Or a company with a smaller market cap with potential for explosive growth? And the fifth question is, what is the total addressable market? How big can this company become in this industry? How much market share can they potentially capture from its competitors? And if it's a new asset like Bitcoin, I look at the adoption trends and its usage. For example, when I first started investing into Bitcoin back in 2019, I researched thoroughly on Bitcoin, spending hours and hours studying and learning all I can about Bitcoin before I pulled the trigger. So back then, I saw it as a scarce, centralized asset with only 21 million coins to ever exist, a secure blockchain which is fully decentralized, an open monetary network, self-custody, and is borderless. I felt that was a truly amazing asset with so much growth potential, and the best thing is, many people and government around the world haven't even fully understand its potential yet. I knew it was still early and it was a bet worth taking. And now, major institutions like BlackRock, Fidelity has created ETF for Bitcoin, sovereign wealth fund, banks, and even countries like the US is getting involved in it. And companies and corporations around the world are buying Bitcoin. Even the US President Donald Trump is openly expressing his support on Bitcoin. And the best part is, the US has adopted Bitcoin as a strategic asset and is looking to buy more. And this will only lead to more countries around the world adopting the same strategy as the US because they don't want to get left behind. All these are tremendously great news. Completely different just from a few years ago. And this is telling me that adoption is growing and the price has a long way up to go. Now, of course, nothing is guaranteed. Anything can happen. But because of all this research that I've done, my conviction to buy more and hold remains strong as ever, despite Bitcoin falling 70 to 80% during the bear market. I'm not asking you to invest in Bitcoin or any of the stock that I mentioned, so do your own research before you decide to invest in anything and only invest on what you can afford to lose. But if you want me to do a video about Bitcoin, let me know in the comments below. I'll try to make one for you guys. So the takeaway is this: if you truly understand the asset that you're buying, you will have the conviction to hold it for the long term and even buy more during a market crash. And by researching and understanding the asset that you're buying, it also increases the success rate. Now, the fifth mistake that I've made is lack of discipline and patience. You see, one of the hardest things to control in investing is your own emotions. Greed, fear, FOMO, fear of missing out, they will wreck you if you're not careful. We always hear this famous investing advice, which is to buy low and sell high. But trust me, it's the hardest thing to do, and most of the time, we end up doing the opposite, even myself sometimes. This is because fear of missing out always gets to us. You see, I used to chase prices when they're going up. I tell myself if I don't buy now, I'm gonna miss it. And I end up buying near the top. And then the price would crash hard after I buy. I ended up feeling like a fool and slapping myself, saying that if only I waited a little longer and stick to my rules, I could have bought at a lower price. Now, I mentioned that I learned a lot about technical analysis, so I do have a pretty good understanding on how to read charts. So I would draw trend lines like support and resistance so that I can see the market structure and have an educated guess on where the price might be going in the next few weeks or months. So for example, when I found a stock that I really like and I'm eager to buy in, but the price was going up, I would draw a resistance and support line. Now, you see, a resistance line is where the price might be going up and going to top and get rejected, come down. And the support is where the price is going down, it will reach the support level and it's going to bounce up. So I tell myself that I will only buy if the price retraces back to its support. But as days goes by, the price just doesn't retrace and start to stall. I will start to get nervous thinking that, is this stock going to come down? What if it takes off? I will miss this move completely. I then feel panic and then I buy, only to witness the stock goes back down to my support line a few days or weeks later. So if I just have a bit of patience and waited, it would have gone back to my support line and I could have bought at a better price. Now, apart from panic buying, I also used to buy in too heavy in one go, instead of dollar cost averaging and buying in few tranches over time. And because I put all of my capital at one price point, And when the stock goes down further, I basically have no more extra cash to buy. And I can't tell you enough how many times this has happened before I finally learned my lesson. So say for example, you have 10,000 to invest in the stock. You can split it to 5 times by buying 2,000 each time at different price so you can average out your entry costs. Now this goes the same for selling and taking profit as well. People thought buying is hard, but actually selling is just as hard. Because when you're in profit, you thought the price is going to go up forever. And I didn't have an exit strategy at the time. Even when my assets were up significantly, I didn't take profit and I kept thinking that it would go higher and higher, not knowing that the stock has already went up too much too quickly and it was way overvalued. And when the crash came, I lost all my gains. So if I have just stuck to a plan and taken some profit and rebalanced my portfolio, things would have been way much different. So the takeaway is this: be patient when buying, be disciplined when selling, always have a plan and stick to it the best you can. Don't let your emotion take over. And as the saying goes, if you don't learn to discipline yourself, the market will do it for you. And now, the market has humbled me like a little puppy. And now for the bonus mistake, not going in hard enough. Now this one might sound contradictory after everything that I said, but hear me out. Great investment opportunity don't come very often. And when you found one, you know it in your gut that this is the one. You see, my biggest regret is not going hard enough when I actually found it. I should have deployed way more capital into the asset and took on more risks, knowing that I can afford to lose if things didn't turn out the way that I expected. Now there are a few assets and companies that I truly believe in. I did the research and understood the fundamentals, but I spread my capital too thin. I diversified too much, thinking that it was the safest thing to do. And yes, diversification reduced risks, but it also reduced your upside. If I had gone in heavier on the 2 or 3 assets that I truly understood and believe in, my portfolio would have looked very different today. And instead, I bought 20 to 30 stocks thinking that I was smart, but most of the stocks perform average, and only 3 to 4 stocks perform pretty well. And because I only have very little capital allocated to the winning stocks, it didn't really make a big impact to my overall portfolio. But if I just done my research and stick to the 5 to 10 highly convicted stocks, the return could have been much more. So sometimes the risk isn't going in too big, it's not going in big enough when the opportunity is right. Now my philosophy in investing is that I'm not afraid of losing or being wrong, but I'm afraid of missing out the opportunity when I'm right. Missing out on the right opportunity scares me way more than losing and being wrong. And I always say that the biggest risk is not taking any risk. And this is how life-changing wealth are made. And of course, this applies to only invest on what you can afford to lose and your ability to recover from it. Now here are my final thoughts. Don't overcomplicate it. If there's one thing that I've learned over 10 years is this: investing doesn't have to be complicated. If you're not a big investing junkie like me, you don't have to try to predict every market move, chase all the trend or overtrade. Just learn the basic and build good habits. Because the truth is, wealth is built by patience, discipline, and some risk taken. Now I will be making a video about my thought process on how I pick winning assets. So if that's something that you're interested in, make sure to subscribe to this channel so you don't miss out that video. Now if you found this video helpful, please do me a favor, drop a like, share it with someone who's just starting out investing. And let me know in the comments, what are your biggest investing mistake? I'd love to hear from you guys. So that's it, and I'll see you guys in the next one. Peace!